Every strategist eventually faces the moment when the strategy's consequences become the strategy's constraints, when the moves that were designed to create advantages begin generating the specific pressures, the specific reactions, the specific unintended consequences that the original design did not fully incorporate. When the world that the strategy has helped to create starts pushing back against the strategy itself, not through the resistance of adversaries whose opposition was anticipated and priced into the original calculation, but through the more complicated resistance of allies, partners, markets, and domestic constituencies whose concerns were not adequately weighted in the strategic architecture. Mohammed bin Salman is facing that moment, and the specific form in which it is arriving, the debate that Saudi Arabia's latest oil move has sparked, the pressures that are converging on MBS's strategic management of the kingdom's oil policy from multiple directions simultaneously, is revealing the specific gap between the genius of his strategic conception and the complexity of its execution in a world that is responding to what he has built in ways that even his considerable intelligence did not fully predict. The debate is real. It is happening in the boardrooms of the international oil companies that have invested billions in Saudi ventures on the assumption of pricing and production stability that Saudi Arabia's recent moves have complicated. It is happening in the chancelleries of European governments whose energy security planning was built on a Saudi-American partnership in global oil market management, that MBS's strategic independence project is systematically dismantling. It is happening in the corridors of OPEC+, where member states whose interests are not identical to Saudi Arabia's are watching the kingdom's unilateral production decisions with the combination of compliance and private concern that characterizes the coalition's current institutional culture. It is happening in Washington, where the specific combination of Saudi production decisions, non-dollar pricing development, and regional strategic independence is generating the most significant reassessment of the American-Saudi relationship in decades. And critically, it is happening inside Saudi Arabia, in the specific conversations among Vision 2030 planners, among PIF investment managers, among the economic technocrats, who are trying to translate MBS's strategic vision into the specific financial realities of a national transformation program, whose funding depends on the oil revenues whose management is now the subject of the debate. Let's examine each dimension of the pressure and the debate, because understanding the full picture requires looking at all of them rather than any single one. The market pressure dimension is the most immediately visible because it manifests in the specific numbers that financial markets generate and that the world watches continuously. Saudi Arabia's latest oil movement, the combination of production increases, pricing adjustments, and structural reconfiguration toward Asian markets documented in the previous analyses, has produced oil price movements whose specific trajectory is creating a fiscal challenge for the Saudi budget that the strategy's architects are now managing in ways that reveal the tension between strategic objectives and financial necessities. Oil prices at current levels, reduced by Saudi production increases at a moment when global demand growth is not keeping pace with the supply addition, are below the specific budget break-even price that Saudi Arabia requires to fund both its operational government expenditure and its Vision 2030 capital investment at the levels those programs demand. The gap between current prices and the budget break-even is not catastrophic. Saudi Arabia's reserves, accumulated across decades of higher oil prices, provide the financial buffer that allows a period of below break-even prices to be absorbed without immediate fiscal crisis. But the gap is real, and its persistence, the specific trajectory of a Saudi oil strategy that is deliberately adding supply to markets in ways that pressure prices below the revenue maximizing level, is generating the debate within Saudi economic management circles about whether the strategic objectives being served by the production increases justify the fiscal cost they are imposing. The debate is not a challenge to MBS's authority. Saudi Arabia's decision-making structure does not permit the kind of institutional debate that in democratic systems produces audible policy disagreement. But the debate is happening in the specific form that policy disagreement takes in the Saudi system, in the technical analyses being commissioned from economic planning institutions, in the scenario modeling being requested from PIF investment analysts, in the specific financial risk assessments being prepared by Saudi Treasury officials whose professional responsibility is to communicate the fiscal implications of policy choices that they do not have the authority to challenge publicly, but whose implications they are professionally required to document. Those analyses, that modeling, those assessments, are reaching MBS through the specific channels of the technical advisory process that supplements the political loyalty of his inner circle with the professional competence of the technocratic apparatus, and their content is adding a fiscal dimension to the strategic debate that the pure geopolitical logic of the oil strategy's execution did not initially foreground. The OPEC plus pressure dimension is the second front of the debate, and the one whose institutional dynamics are the most complex to manage. OPEC Plus was constructed as an instrument of Saudi strategy, the specific mechanism through which Saudi Arabia amplifies its individual production decisions into collective supply management that gives Saudi price influence a multiplying effect beyond what Saudi production alone would provide. The coalition has served this function effectively throughout the MBS era, with Russia's participation providing the specific additional volume whose inclusion in the managed supply framework gives OPEC Plus the market weight that Saudi Arabia alone could not command. But the coalition's coherence depends on the specific condition that the members' collective interests are sufficiently aligned with Saudi Arabia's strategic objectives that the discipline required by collective production management is worth the individual production freedom it costs. When Saudi Arabia makes unilateral production decisions, as the previous analysis documented, without the collective consultation process that OPEC Plus nominally requires, the condition of sufficient alignment is being tested in ways that the coalition's internal culture has been managing, but that the current period's specific pressures are making more difficult. The UAE's independent positioning, the specific pattern of Abu Dhabi production behavior that diverges from Saudi direction in ways whose strategic dimensions the analysis of MBS's Abu Dhabi confrontation documented, has not been resolved by the confrontation strategy. It has been managed into a state of managed tension whose sustainability depends on the specific calculation by Abu Dhabi, that the costs of more explicit defiance exceed the benefits of the production and pricing flexibility that defiance would enable. That calculation is being affected by the current oil price environment in ways that are reducing Abu Dhabi's patience with the implicit constraints of Saudi-directed production management. The Russian OPEC Plus relationship is the dimension of the coalition pressure that has the most direct connection to the broader war narrative. Russia's ability to participate effectively in OPEC Plus production coordination has been severely constrained by the specific combination of frontline military collapse, infrastructure damage from Ukrainian strikes, and political crisis that the preceding analyses have documented. A Russia in institutional crisis is a Russia whose OPEC Plus participation is less coherent, less reliable, and less strategically valuable to Saudi Arabia's coalition management than the Russia of earlier periods. Saudi Arabia is simultaneously the primary architect of Russian crude's displacement from Asian markets and the nominal coalition partner of Russia within OPEC+. The tension between these two roles, between the strategic competitor in Asian markets and the nominal collective supply management partner, is a tension that MBS's strategic management has been containing through the specific ambiguity of Saudi positioning within the OPEC+ framework. That ambiguity is becoming more difficult to sustain as the concrete competitive effects of Saudi production and pricing decisions on Russian crude's market position become more visible and more directly attributable to Saudi strategy. The Western partner pressure dimension is the third front of the debate, and the one whose specific character reveals the most about the fundamental strategic transformation that MBS's oil strategy represents. Saudi Arabia's relationship with the United States has been the subject of continuous analysis throughout this series. The specific evolution from strategic client to strategic independent that MBS has been executing through the oil strategy, the Chinese financial relationship deepening, the Pakistani military partnership, and the non-dollar pricing architecture. The latest oil move's specific consequences for that relationship are the subject of the Washington dimension of the debate. The American concern is not simply about oil prices, though the domestic political implications of oil price movements that American administrations cannot control because Saudi Arabia is no longer calibrating its production to American preferences are real and are generating real political pressure on the relationship. The American concern is about the systemic implication of Saudi Arabia's production behavior, the specific signal that the world's largest oil exporter is making decisions according to a strategic logic that does not incorporate American preferences as a binding constraint. That signal, repeated across the multiple moves that this analysis series has documented, is accumulating into a fundamental recharacterization of the American-Saudi relationship, whose implications American strategic planning is working through with urgency. The relationship that American Middle East strategy has been built around for 50 years, the specific partnership whose foundational terms were the 1974 petrodollar arrangement, whose unwinding the series has traced, is no longer the relationship that exists. American policymakers who have been managing the adaptation to this change on a case-by-case basis, treating each Saudi oil move as a specific deviation to be managed through specific diplomatic engagement, rather than as an expression of a structural change that requires strategic reframing, are being forced by the accumulation of cases to confront the structural question. What is the American-Saudi relationship now? What are its terms? What can each side count on from the other? And what does the answer to those questions mean for the American strategic architecture whose Saudi component has been foundational? The debate this question is generating in Washington is the specific American dimension of the broader debate about MBS's oil strategy. A debate that is not about whether the strategy is working in Saudi Arabia's terms, but about what its working means for the specific actors, whose interests are affected by the world it is creating. The Gulf Partner Pressure dimension involves the specific reactions of Saudi Arabia's Gulf Cooperation Council partners, whose interests have been affected by the oil price environment that Saudi production decisions are creating. The Gulf states that are not Saudi Arabia, the UAE, Kuwait, Qatar, Bahrain, Oman, have their own budget requirements, their own development programs, their own fiscal positions, that are directly affected by oil prices that Saudi production decisions influence. The specific oil price environment created by Saudi Arabia's latest moves is affecting each of these states' fiscal positions in ways that are generating private concern whose expression through GCC institutional channels is the Gulf dimension of the broader debate. Kuwait and Oman are the most fiscally exposed to the current price environment. Their budget break-even prices are higher relative to current prices than Saudi Arabia's, and their reserve buffers are less substantial, giving them less fiscal runway for the period of below break-even prices that Saudi Arabia's production strategy is creating. The specific conversations in GCC economic coordination forums, whose content reflects Kuwaiti and Omani concern about the fiscal implications of Saudi production decisions, are the Gulf partner dimension of the debate. Qatar's position is distinct. Its primary export is liquefied natural gas rather than crude oil, and its fiscal exposure to crude oil price movements is less direct than the other GCC members. But Qatar's specific concerns about the implications of Saudi Arabia's non-dollar pricing development for the dollar-denominated LNG market, in which Qatar's own exports compete, are a component of the Gulf partner debate that the crude oil focus of most market analysis obscures. Now, let's examine the most interesting and most analytically significant dimension of the debate, the internal Saudi dimension. The specific pressure that MBS's oil strategy is generating within the Saudi institutional and economic system, whose management is simultaneously the strategy's enabling condition and its primary constraint. Vision 2030's funding requirements are the internal pressure point whose management most directly connects MBS's oil strategy to the domestic political economy that constrains it. The specific capital demands of the mega projects, the Giga investments, the human capital development programs, and the institutional transformation that Vision 2030's implementation requires are calibrated to an oil revenue trajectory that the current price environment is not delivering at the required level. The PIF, the sovereign wealth fund that is the primary financial vehicle for Vision 2030's implementation, has been managing the gap between Vision 2030's capital requirements and the oil revenues available to fund them through a combination of international asset deployment, strategic financial engineering, and the specific prioritization of project phases that allows the program's most capital-intensive components to be sequenced around available funding rather than designed schedule requirements. The sequencing, the specific delays, the scope revisions, the timeline extensions that previous analyses documented as the reality of Vision 2030's implementation against its original ambition is both a reflection of and a response to the oil price environment that Saudi Arabia's own production decisions are partially creating. The strategy that is serving Saudi Arabia's geopolitical objectives is simultaneously creating the fiscal pressure that is constraining the domestic transformation program that the strategy is supposed to fund. This tension between the oil strategy's geopolitical objectives and Vision 2030's financial requirements is the specific internal pressure that MBS's management apparatus is working hardest to contain. Containing it requires the specific management of the timeline and scope of Vision 2030's implementation in ways that maintain the program's credibility as an achievable transformation while accommodating the fiscal realities of the current oil price environment. It requires the specific communication of the program's progress to the domestic audience, the Saudi youth, the Saudi business community, the Saudi technocratic class whose expectations of Vision 2030's delivery are the social contract, whose management MBS's domestic political legitimacy depends on, in ways that acknowledge genuine progress while managing expectations about pace. The debate about MBS's oil strategy from this internal perspective is not a debate about the strategy's geopolitical sophistication. That sophistication is not in dispute among the Saudi analysts and planners who are closest to the strategy's conception and execution. It is a debate about the specific trade-offs between the geopolitical objectives and the domestic transformation objectives, whose simultaneous pursuit is the fundamental challenge of the MBS project. Is MBS under pressure? The honest answer requires the specific calibration that all honest answers about complex situations demand. MBS is under pressure in the specific sense that every aspect of his strategy is generating reactions that require management. Reactions from the oil market, from OPEC+, from Western partners, From Gulf neighbors, from Vision 2030's fiscal requirements, and from the specific expectations of a Saudi population whose social contract with the transformation program is a political commitment whose management is not optional. But pressure is not crisis. Pressure is the normal condition of ambitious strategy executed in a complex world that does not cooperate with strategic visions by remaining static. The specific pressure that MBS's oil strategy is generating is the pressure of a strategy that is working, that is producing the strategic outcomes it was designed to produce, in the process generating the reactions that successful strategy always generates from the actors whose interests are affected by it. The debate that the latest oil move has sparked is not the debate of a strategy that has failed. It is the debate of a strategy that has succeeded in transforming the environment sufficiently that the transformation is forcing every affected actor to engage with what the new environment means for them. The pressure on MBS is real. The strategy's execution is creating genuine challenges that require genuine management. The debate is substantive and reflects genuine concerns from multiple legitimate perspectives. And MBS's management of that pressure, the specific combination of strategic consistency and tactical adaptation that has characterized his approach to every previous challenge, is the variable whose assessment determines the answer to whether the pressure represents a manageable tension or a fundamental constraint. The history of MBS's management of previous pressure points, the Qatar blockades management, the Yemen conflicts management, the Khashoggi aftermaths management, the oil price wars management, suggests a leader who absorbs pressure without fundamental strategic deviation, who manages the specific tactical adjustments that pressure demands without allowing those adjustments to compromise the strategic direction that the pressure is testing. The latest oil move and the debate it has sparked is the current iteration of a recurring pattern. MBS makes a move. The move sparks debate. The debate generates pressure. MBS manages the pressure while maintaining strategic direction. The analysis community declares the pressure existential. The pressure proves manageable. Whether this iteration follows the pattern or breaks it is the specific uncertainty that the honest analysis must acknowledge rather than resolve through the false confidence of prediction. What is certain is that the debate is real. The pressure is real. And the world that Saudi Arabia's oil strategy is creating is real. What the world does with what Saudi Arabia has created, and what MBS does with the pressure that the creating has generated, is the story whose next chapter is being written right now.